Well, we know in a high interest rate environment, real estate has struggled as an asset. There's been a lot of sector-specific concerns as well, concerned about the retail sector as well as high office vacancies. In some ways, industrials have escaped the worst of it. The industrial landlords, Dream Industrial REIT, is an example of that. It's down over the past year, but not down as much as the TSX Real Estate Index. And if you take a look at the net asset value, the value of assets that it owns compares to the credit that it gets in the public markets, the value of the assets that it holds is a little bit higher than what it gets credit for in the public markets. To talk about this disconnect, the fundamentals of the business, we've got Alexander Sannikov, President and CEO of Dream Industrial REIT. Thanks so much for joining me.
Thank you for having me.
So first, maybe let's educate investors about the portfolio of assets you have. When you're talking industrial, what does that mean to a Dream Industrial REIT?
Absolutely. So Dream Industrial is primarily in Canada and Europe. We have small exposure to the United States, but that's not significant in the context of the entire business. And both in Canada and in Europe, we are focusing on major urban centers, and we're focusing primarily on what we call urban industrial. These are well-located, difficult to replace assets, located close to population centers. And these are the assets that have not seen significant supply over the last many years, actually. And in Canada, we are primarily in Toronto, Montreal, and Calgary. In Europe, and Europe is a large market, so we are pursuing a pretty focused strategy. We're primarily in the Netherlands, Germany, and France. And within those markets, we're focusing again on urban industrial in major population centers.
And so what is it? That's distribution, that's warehousing?
That's what broadly is called last mile. These are well-located, highly functional assets that are situated in close proximity to major arteries, major population centers, and transportation routes for employees of our customers.
And let's talk about who those customers are. What kind of growth vectors are you indexed to? Is it kind of tech, e-commerce? Is it grocery? Is it just, plain old industrial activity? We're investors, I think, trying to get a sense of how ingrained are you or attached are you to the fate of economic growth in the country? Absolutely.
We are obviously a part of the broader economy, but we are a supply and demand-driven business. And demand for industrial has been rising and rising rapidly over the past 4 years. So first it was e-commerce, then supply chain resiliency. Mm-hmm. Afterwards, we saw a push from reshoring. And in Canada in particular, population growth has been a driver for industrial demand. Simple formula: more people, more stuff.
Yeah.
And and all of these trends continue, albeit monetary policy is doing its thing, and the demand is not as broad-based as it used to be. And so supply becomes a much more meaningful component of that supply-demand balance. And so the markets we're in, Canada and Europe in particular, and urban component of industrial segments within those markets, are doing quite well vis-a-vis supply-demand dynamics. So to go back in history a little bit, this surge in demand over the last 4 years has been met with some supply. Mm-hmm. And many markets in North America, in the United States in particular, have seen a more meaningful supply response, so new construction. In Toronto and Montreal and Vancouver, supply response has been very muted. Mm. And same in Europe. And that's partly because of land availability and geographic constraints, partly because of planning restrictions. Mm-hmm. And in Canada we have winter, so yeah, it takes longer to build. And so we find ourselves today in very balanced markets, in Canada in particular, where Toronto, Montreal, Vancouver rank the lowest amongst all major markets in North America for industrial vacancy and availability. And our supply relative to existing inventory is the lowest as well. Toronto and Montreal, for example, are at 1% relative to existing inventory in terms of supply pipeline. I'm
curious about the differences or your different experience in Canada versus Europe.
So from a supply-demand dynamics, we see that these markets are similar. Europe has different challenges vis-a-vis new planning for new industrial, but broadly, its similar supply is constrained. Europe is starting off a much lower base. So rents in Europe are a third to half of what they are in major North American markets. And so we expect that the run rate for rental growth is pretty strong in Europe.
Oh, interesting. And so is that, when you look at relative expansion opportunities, does Europe skew as more favorable?
So Canada has been really benefiting from population growth. And what we are seeing in Canada is because of all of these drivers and significant constraints on supply and significant concentration of industrial stock in markets, for example, such as GTA, rents have been rising dramatically. And so on a total return basis, we continue to allocate more capital to Canada right now, especially within our private capital partnerships.
I mentioned the disconnect. REITs, a lot of REITs are in this position where you can buy real estate cheaper in the public markets than you can in the private markets, the transactions that you're seeing. We've seen some private equity players transact, in residential, Tricon, for example. I'm curious what you're hearing, what you're seeing in terms of that private interest. Whether it's looking at public equities or whether, those transactions suggest things are getting more robust or firming up. What do you see there?
So what we continue to see is that public markets are driven by momentum, driven by sentiment, and what's frequently described as the first or second derivative of expected growth. And private markets are driven by fundamentals. What's the expected outlook for rental growth, vacancy rates, and total returns that private investors can achieve on levered or unlevered basis on real estate assets? And from that perspective, Canadian industrial, Toronto industrial in particular, has been screening very well for many global players, and there will be, we have seen more private equity players come into Toronto industrial market. The privatization of Summit Industrial Income REIT that we pursued last year together with GIC was a reflection of that trend as well, where private markets are valuing real estate differently compared to public markets.
I mean, you talk a lot about the robust demand and fundamentals and growth opportunities than you see. Interest rates are obviously a factor. And how do you see that playing out? How do you see that evolving? Is that what kind of gets the company, the sector, sort of out of, I've been describing it as the penalty box?
Yeah, well, that's the sentiment and momentum in public markets. When we look at real estate from a private markets perspective, and when we plan our business, we are modeling interest rates to stay elevated for a very prolonged period of time. That's how we're organizing our affairs. That's how we're underwriting returns on transactions. And we're happy to be surprised to the upside. And even with these conservative assumptions, these assets pencil to very attractive returns.
The dividend yield is high. It's around 5%. But I noticed that the distribution, the amount that you pay out, has stayed the same for over 10 years. Do you think about increasing it?
We have been focusing on reducing our payout ratio and reducing our leverage. So our payout ratio has reduced considerably. We've delivered 11% compounded FFO per unit growth over the last 3 years, and the outlook for FFO per unit growth is strong. At the same time, we reduced our leverage, and now we are in a strong position. Our payout ratio is at about 70%. Our leverage is pretty conservative, although we would like to see it lower. And so as these metrics trend in the right direction, and as we evaluate general priorities for capital, we will absolutely look at our distribution policy.